Live 2021, baby.
2021 Finance Fridays 2021. This is our first episode of the new year.
This is the first one?
This is the first one. We wanted to jump on here and say hello to all of our followers. Today's episode is just going to basically be a summary of 2020, some wins. We take a look at some really interesting facts that we were able to help with our clients and just kind of set the mood for next year.
Yeah. Hopefully you guys aren't too hungover. Obviously, you guys were preparing your goals and stuff for 2021 and not drinking last night, so that's good. You're well hydrated and rested. As am Josh and I. Yeah, guys, we just want to take a look at, everything that we brought to social media last year and, shed some light on it. Some of the cool things that we talked about and brought to the market and, just leave the floor for you guys, what you guys want to see. Here's what some of your goals are and how we can help you guys in 2021 and keep on crushing your goals and building your portfolio.
Yeah. So, obviously we're just going to start off by saying thank you to all of our supporters, all of you. Without any of you guys, we couldn't do what we do. To our media team, to our business partners, to our past clients, our current clients, and even our future clients, we thank you in advance. We are able to help as many of you as possible because you guys follow us and allow us to advise you. So first, big shout out to everybody who we do business with. We're looking forward to having an absolutely mammoth 2021.
Yeah, absolutely. And special thanks to Matt McKeever. Obviously, he, gave us the opportunity to come on to his YouTube and, allow us to share our content with his audience. And, we've connected with a lot of you and built a lot of relationships with you guys, and it's turned out really well. And obviously, we're continuing into 2021 with that. So that's, going to be a strong year to start that off. And then to the Click Media team as well, too, who runs Matt's socials and our socials. They've done a great job helping us and keeping everything flowing smoothly. So obviously couldn't have done that without the aforementioned people.
Of course. So one of the big things that we wanted to touch on right away was some of the most important tools that we were able to help our clients with this year. One of them was aggressive offsetting. As many of you know, lenders take a look at income on properties a little different depending on what type of lender you have. We were able to help people use their portfolio income to qualify and scale their portfolios. It's one of the tools that we utilize the most in our toolbox just to help with debt servicing and to help people scale faster than initially what you'd be able to. Second is, expanding your portfolio beyond 3 or 4 properties. It's something that we've kind of set ourselves in the market to help people with. Obviously, the bank only allows you to purchase so many properties. Once you're kind of capped out in regards to risk from a bank or personal debt servicing qualifications, we try to find a way to help you scale into more residential properties or start looking at commercial opportunities. We are really trying to help people either make that quick decision whether to use alternative financing or to move into commercial. There is something to be said about taking a look at both options and the upfront capital required for each option. Depending on the circumstances, either way really works.
Yeah, I think the biggest thing that, for us, that we kind of realized with the investing space is just how much misinformation is kind of out there for some of the things. There's quite a few investors that we talked to this year that, thought it was impossible to grow a portfolio beyond 3 or 4 properties. And, we see portfolios every day that have 6, 7, 8, 9, 10. We've even seen a couple investors who have residential portfolios up to like 20 to 30 properties sitting in there. So, it's definitely doable. 3 to 4 properties, that's just a limit that the A lenders really put on you, the big banks. Moving on to the B side and the alternative lenders, they have essentially the capacity to do 6 to 10 plus properties. Each lender has their own certain parameters that they qualify at and their own regulations, but depending on which lender you're able to use. And we have lenders that allow you to have up to 10 properties and maybe a little bit more, as long as you can debt service it. So 3 to 4 definitely doesn't end there. You guys have the ability to get that portfolio up to 10 properties, and then once you've kind of hit that mark, it's taking a look at converting those properties, either if you want to refinance them or sell them off and start to get into the larger multifamily and build your portfolio that way. So just expanding forward.
One of the interesting little tidbits of information and kind of like not a loophole, but a product that most banks don't offer that we were able to help our clients with was finding non-insured purchases up to 90%. We did make a video on it earlier in the year. This basically allows people to get a conventional loan up to 80% loan to value. And then from there, you can get secondary financing for 10%. So either a second mortgage, or you could kind of negotiate a VTB, and then you'd have to come up with the 10% for the down payment. Now, you obviously have to debt service the secondary financing in there to make it to make your ratios work, but it allows you to get into a property without putting 20% down, without having to pay any insurance premiums, which is a really interesting, unique product that isn't really available for any other bank. So we thought that was kind of a really interesting tool in our tool belt that we can offer to our clients. And a bunch of our clients like the product, and it fits in certain situations. So it's one of those highlights of this year that we thought was a little bit more interesting than some of the regular products that we have available.
Yeah, I think we did maybe 2 or 3 of them this year where we were able to use that second mortgage. And the big thing here, guys, is this isn't a private, solution in terms of that initial loan. It's an 80% loan to value first position mortgage with a conventional B lender, and their rates are somewhere between 2.94 and 3.04%. So, it not only is it a B solution, but it's a B solution with a really competitive rate. You're essentially back into old AAA rates. So it's a solid product. And then you're just utilizing a private second for an additional 10%, covering half your down payment, like Josh said. So, I think it's a strong solution for a lot of borrowers out there, especially if you're looking to add a lot of value. You're going to have the ability to pay out that private second on the refinance. And even though the private rates on a second are somewhere between 12 to 16%, just on that 10% down payment, it doesn't really come out to a whole lot. You're looking at something probably between $500 to $700, depending on the down payment. In the grand scheme of things, you're only really going to be in that BRRRR for probably 6 months. So, you're not even really carrying it for the full year. So to be able to utilize that and get into the property, everything that we bring to the table is really just an option to get in, right? The amount of tools to be able to get into a property, getting what you need to get done, turning it into a cash flowing property, then finding a solution to get out. If you can't get in, there is no end game solution. So
agreed. And one of the things that Aaron and I really wanted to do when we started making content was let you guys understand the tools that we have available. One of the tools that a lot of investors use is private money. There is kind of a negative stigma in certain markets around the use of private money. We like to repurpose that as a tool for a lot of our clients to be able to get to where they need to go. Private money does have situations where you really shouldn't use it, and it has situations where it is extremely effective and you should use it. We are trying to share how that tool can be used effectively as a step or a tool to be able to help you grow your portfolio. Other actors in our industry obviously don't like it because of the equity position that most of them hold. So if any of you don't know, private lending specifically is an equity position loan, meaning they don't necessarily care about the gross debt service or total debt service. So your ability to be able to pay that loan, obviously they want to make sure you can pay it, but it's more or less weighted on their equity position in a property. Obviously it comes with interest-only payments and more risk than necessarily would be with a regular conventional loan. But to be able to get into a flip where the place needs to be gutted, or a place where there is like a crack in the foundation, for example, but there's a huge lift in the property once you get that crack fixed. There's a handful of different situations that make private lending viable. So one of the things we wanted to do this year was really just put emphasis on the fact that it's not something for everybody, but it is a tool that should be used or considered if you are in a situation where profit is available.
Yeah, guys, and you have to kind of shift your focus when you're looking at a potential private too, because you're not going to cash flow in the first year. You know, if you're going to run the numbers and you're going to realize that your cash flow is going to be in the red a little bit, and that's just the cost of getting into the purchase. You know, it has to be a long-term goal and looking ahead and realizing that this is a solution to get in, and then do what you need to do with the property, refinance it, and start to cash flow. You know, there's a few people that we've worked with, and the biggest kind of upfront thing is like, well, you know, I ran these numbers and this, you know, I'm not cash flowing this year. And you're not. It's correct. You know, in most cases, I'd say probably all cases on private, you're probably not cash flow positive in the first year, maybe even year and a half when you kind of just take a look at everything. But again, it's a solution to get into the property and make that cash flow down the line and have that equity and liquid asset gain down the line as well. So it's a long-term play.
Second thing we wanted to touch on was our vendor take back options that we were to help out clients with. Conventionally, with an A and B bank on the residential side, you can't obviously use vendor take backs as secondary financing, although you can use vendor take backs and very strategically when it comes to the acquisition of a property. There are credit unions out there who will allow you to use vendor take backs in second position behind them, as long as you meet their debt servicing qualifications for the NOI on the property. VTBs can be extremely lucrative. We've had clients who have had 0% VTBs, giving them the ability to take possession of a property and then do use all the capital expenditure to be able to add value and then refinance out. Some are very expensive. Some are very lucrative. There are definitely situations to use VTBs. One of the things we wanted to really emphasize to all of our investors that we work with is that we have a lot of people coming to us saying, I got a VTB, you know, what financing can I get? And they want these bank rates. And unfortunately, a monoline or like a big five bank isn't going to be able to use that type of financing. So it's great to be able to negotiate those flexible financing solutions. But unfortunately, for the acquisition of a property with a VTB, it can be difficult to finance conventionally in regards to cash flowing a property. But it is good for acquisition if you do want to do like a BRRRR strategy and get in there, fix it up. It definitely less dead capital out of your pocket to be able to get that project done.
Yeah, and again, guys, it's the difference between, you know, getting into the property or not getting into the property, right? Not building a portfolio or getting into a portfolio. Just keep that long-term kind of goal in sight. Another strong solution with private lending is for JV partnerships and borrowed down payment. If you're borrowing down payment from an investor and they're not coming on title with you, maybe they have poor credit, maybe they have a lot of debt, or maybe there's just some other reasons. Maybe they already have a large portfolio of rental properties. You know, we can't use that investor, promissory note or investor loan to be able to get into conventional financing, right? It's conventional financing on both the A and the B side. It's got to be some sort of own resource or immediate gift from a family, right? So again, if you guys are in a JV partnership and that's what you guys are looking to use, private financing is going to be the option to allow you to use that down payment, get into the property, and then we can look at a solution to refinance you guys out into conventional lending.
Obviously, unless the JV partner wants to be on the application. Yeah.
Yes.
Last but not least, 100% financing. It does exist. If you purchase extremely undervalued, there are equity lenders out there who will lend on the true loan to value of a property and not quite on the loan to purchase. We have had a few clients where we have structured a first and a second, allowing the private lender to get the rate of return they're looking for without having to have a large monthly debt obligation on the first. So usually they're around maybe 7.5%, maybe 6.5% on the first, and then the second is quite expensive. But because they have their loans tiered behind themselves, it reduces their overall risk and they're able to lend on the actual value of a property. Sometimes these lenders are going to require 2 appraisals. So if you have one, they might want another one just to verify from somebody on their trusted appraisers list exactly what the true value of that property is. There are a handful of ways to get 100% financing, but the majority of them are flexible solutions.
Yeah, having collateral equity in a property, vendor take back, borrowed investor down payment. I mean, these are all ways to essentially get 100% financing, other people's money type of financing. As long as it's really not coming out of your pocket, you can get that 100% financed, but 98% of these solutions require, a private loan. The closest you can really get to 100% financing conventionally is going with the B lender, who allows you to use a 10%, that 90% second position mortgage. And then if you had a HELOC, you could use the rest of that 10% coming from your HELOC. That's as close as you're going to get to about 100% financing on the B side. Everything else is really going to require some sort of private solution. So.
Yeah, so we just actually had a question on Facebook from Shahil Sharma. Happy New Year's, guys. Is it true that COVID has caused most A and B lenders to reduce their loan to value, max 70%? Initially, when COVID kind of hit, there was a liquidity crunch in regards to the lenders didn't really know what was going on. If you can remember, they jacked rates up to stop the influx of deals just to see what was going on. And then obviously rates started decreasing once the stimulus was given and the green light was given from the government. Conventionally, right now, I haven't seen any A or B lenders really reduce their loan to value when it comes to purchasing and refinancing. There have been some changes in regards to the total max cash equity takeout from some lenders. Some lenders have reduced their cash takeout to $75,000. There are obviously A lenders out there who don't have a cap, but the ones that are looking in the alternative space or the subprime space, some of them have reduced the total amount of cash you can take out without prepaying some sort of debt obligation.
Yeah. Other than that, I mean, I think in Ontario, it hasn't been really affected too bad on the second time around. Alberta had, I think it was like 8 or 9% of all deferrals in Canada for their mortgage. So Alberta's been hit pretty hard. They have definitely seen a reduction in loan to values, and the rates are increased a little bit. And I think there's even some areas that they just weren't lending in currently. So if you're out west in some of those areas, you might see more of a direct impact to lending. But in Ontario, it's stayed relatively the same. Other than, like Josh said, being able to pull out equity, there's been some that have decreased it. There are a few lenders who have still, keep their equity takeout around 200,000. So I mean, all in all, it hasn't really impacted much in the mortgage world and the financing after they kind of had that initial feeler with COVID and how it was going to affect. Things are still pretty normal. We did see a little bit of a decrease in private lending the first time around. A lot of private lenders kind of took their money off the market, really decreased their loan to values. But, again, right now, we're still we're going 100% right now in the privates. They're still as aggressive. We're still seeing high loan to values with collateral. So, as long as you can securitize it on the private side, a lender is going to be okay with it. But everything is pretty much back up and running normally right now.
Yeah, if anything, there's actually been an influx of private capital into the market. There are quite a bit of people right now who are putting money in the market. There's a lot of it out there. The rates have necessarily stayed the same. The institutional private lenders have kind of reduced rates a little bit when it comes to specific areas. Some like institutional private capital firms are putting 75% loan to value money out at 5.5%. They are charging a 2.5% lender fee on their end, but the total carrying cost on some of the private money out there right now is pretty cheap, and there's some great solutions. We did get a question just come in. It says, Happy New Year's. If one has 2 different mortgages with A lenders and the third property does a VTB on the fourth investment property where you seek out an A lender, does the VTB hurt your mortgageability? So the VTB is just going to be reflected as a mortgage on your application. If your VTB obviously is an interest-only loan, that monthly payment is probably going to be higher than what you initially would have on an amortized payment, just because usually VTBs are more expensive than, they're private money. They're more expensive than institutional loans. So it would affect your total overall debt servicing if you were looking for another property, but we would just factor it in the same way we would factor in a regular mortgage.
That's a good question.
It's a good question.
Another question here on YouTube from Josh Norris. Planning on wholetailing this year, so buy, close, relist, and then sell right away. It's a good, strong strategy right now with the hot market. You have the funds for 20% down. Any suggestions on lending options for this? I mean, there's obviously a few. Depending on how long you really think you'd be able to keep that property on the market, or if you could close on it within 2 to 3 months, and you have some equity available. I mean, finding some ways to just reduce the amount of money you put down, could be a good strategy. There's a few products that we have.
There's a handful of things that I would look at if I was going to implement that strategy. Number one would be fees. If you're only holding it for a short period of time, you're going to have to factor in the broker fee and a lender fee if you're using private financing. Now, those broker fees and lender fees, they may add up, obviously, depending on how many wholesales you're looking to do. Secondly, I would look for an open term or semi-open term at least. When you break most private loans, unless you specifically requested, are a 3-month interest penalty to break. So if you are planning on only holding it, you do want to figure out some sort of flexible term solution where maybe it's open after a certain period of time, or if it's fully open. Most private lenders do charge some sort of surplus to have a fully open term instead of a closed term. But I would definitely take a look at, make sure your fees are decently manageable when it comes to your bottom line for profit, and your term is open if you're looking to exit it at the start of the loan.
Yeah.
Good. And if you have more down payment, then obviously your rate is going to be lower. I mean, I think I'm finding the sweet spot right now is about 25% down. At 25% down, if you're buying anywhere in like the Golden Horseshoe GTA area, most of these institutional private lenders are able to give you a decent rate. You look at 6.5 maybe, which is really solid when it comes to private financing. So we definitely have the ability to be able to structure those for you, but obviously, we preach this all the time, but knowing your exit strategy up front is the most important thing. So structuring that private loan that's going to have those open terms is going to be important for your strategy.
Mm-hmm. Yeah. No, it's really just about minimizing overall cost of acquisition and exiting, right? So if you can get into an open mortgage and you reduce your exit cost, that's perfect. And then anything you can do to minimize upfront costs as well. It's just about keeping as much money in your pocket. So if you have some thoughts, definitely feel free to reach out to us, and we can take a look and we can run all the costs and just give you a few options and choose which one's going to put the most amount of money back in your pocket.
One of the big products that we launched this year with our partner Calvert Home Mortgages was a 20,000 down product. It has, it's been extremely successful with the clients who've used it. A lot of them love it. It really allows people to kind of cut the dormant capital out of your investment strategy. So instead of having to have maybe $100,000 locked up in dormant capital for a flip, you're now able to use that capital to either scale or to get into this type of investment. And usually or historically, flips were probably the most capital intensive investment vehicle when it came to real estate investing. You had to have at least 20% down and then all of your costs to do the renos and hold the mortgages. So, it was costing people a few $100,000 roughly, or at least $150,000 to get into these properties and to do these properly. So we were able to sit down with Calvert and work out how to get this done. So we're finding a lot of success with a bunch of our people right now on getting these short-term flips done really quickly, and they like it. Obviously, it isn't for every single situation. If you're looking to be in the flip a little bit longer, we do have alternative solutions, but really great product.
Could be a good option if you are looking to wholesale as well too. I mean, if you're going to be able to close on it in a month or two, you can get in there, just do a quick little touch up and paint while it's relisted. Minimal cost to get in. It could be a great product for something that you're going to be able to sell right away in 2 to 3 months.
Yep, and we're possibly looking to do a 0 down flip for some of our lucky people. So if we've worked with you before and you've done the Calvert Home Mortgage or you closed a deal with us and we have a past relationship, we are going to be offering 0 down flips this year. meaning we will cover the down payment for your loan as long as you qualify. We're looking to offer it. Obviously, we're going to do a little bit of a test pilot project at the start of maybe Q1, and then we'll see how it goes and possibly roll it out to the rest of people. But we are working on some really cool stuff to help everybody out and try to get you guys into some more deals.
Yeah, absolutely. We're excited about that. And like Josh said, we will keep you guys posted once we officially get all the details worked out and are ready to fully roll it out. So keep your eye out for that. What else did we take a look at this year? We talked about cash out refinances versus HELOCs. For those that are looking to build their portfolio and expand, how best to take out your equity, what to do, what's the best use case, and which scenarios are they good for? Both products are great. You can never go wrong with having a HELOC registered on a property at one point or another. One of the things we talked about is, if you're going to get a HELOC, try to, get that HELOC registered early on. Just as you begin to build your portfolio and you increase more liabilities, it does become a little bit tougher to qualify. With HELOCs, you are qualifying, 2% above the contract rate. So it is a little bit trickier. So doing it earlier on in the game while you have less liabilities can definitely be helpful. Just some things to keep in mind, like HELOCs only go to 65% value on the property. So you do get access to a little bit less in terms of equity than you would on the refinance. But some of the pros are, you're not paying any interest on that right away. It's per use. It is an interest only payment. Versus whereas on the refinance, you start paying that principal and interest right after a close. So immediate repay back there. But on the refinance side, you do get access to the full 80% equity in your property. You are able to use that equity takeout for really anything. There isn't anything that it's really limited to. So if you're looking to use it towards a down payment, you can use the full amount. Whereas some HELOCs, you may only be limited to using 10% of your down payment from a HELOC. Mm-hmm. There are some lenders that allow you to use the full 20%. So depending on what situation you are, one might be better than the other. But again, you can never go wrong, getting that HELOC earlier on in your investing career and having that to fall back on later down the road.
Sure. So we actually just got a question on Instagram. Breaking a CMHC insured mortgage for a refinance. What kind of cost should you be planning for? That's a great question. A lot of our clients don't quite understand. So, we can break it down actually right now. So when you purchase a property, let's hypothetically say you have 5% down on a mortgage. CMHC charges you a 4% premium on the insurance. So essentially you're in your new purchase for 1% equity position. Now, most people who are looking to refinance, let's say you're not doing the burst strategy because it doesn't really make sense for an insured mortgage product, just because of your equity position and how much you would have to increase the equity in a property to be in such a short period of time. It'd be very difficult to do. But if you were looking to say refinance 3 years into your 5-year term, for example, you would have to take into consideration there are a few costs. The entire CMHC premium was already built into your mortgage. So you're not getting that back. So if basically 4% of the initial purchase price is the fee, so that's built in the mortgage and it's already paid on the start of your mortgage. So that's a cost that most people don't incur or don't think they incur just because the mortgage is registered on title. And when you put your down payment, a lot of people don't realize that 4% is initially paying the insurance premium. Some costs you're going to consider on refinancing. One is going to be your appraisal. So you're going to have to get it appraised. Second is going to be some lawyer fees. Depending on who you're getting your refinance completed with, it's going to cost you between $1,800 to $3,000. That's from an A lender to a private lender, just across the board. If you are working with a B lender for your refinance, it's going to cost you 1% broker fee and a 1% lender fee. If it's on the A side, you're just looking to refinance with the bank or financial institution that you currently have your mortgage with, then there is no broker fee or lender fee attached. So all the standard fees that you would essentially have for regular refinance would pertain to that specific situation, although you just would forego that CMHC premium that you paid on the initial purchase of the property, which most people don't realize. And that they paid out of the advance.
Yeah, and you're also paying a tax premium on that as well too. So not only is there a 4% premium on the insurance that gets built on, but you're also paying, I think, 8% of the actual 4% premium in a tax on closing. So it, like Josh said, it doesn't make sense to put 5% down. If you were looking to go with a minimal, put 15% down, put 18% down, at least build as much equity into it as possible, and save yourself from some room to be able to refinance out. It is doable at 18% or 15% down, 18% down. You're not going to have as much room, but you still can. But a minimum 5%, like Josh said, you're in there for a 1% position. And it doesn't make sense to incur all those extra costs just to exit out, 2 or 3 months down the road. So,
and most people don't realize that your maximum loan to value you can pull out is 80% loan to value. So if you have a 1% equity position, not only are you force appreciating your property by almost 20% just to hit the bare minimum, anything above 80% is your equity you can pull out. So, to make it worth your while, you're probably looking at 30% appreciation. So, year over year, even if you have 7%, you still have to do some sort of value add to the property to get any equity out, which most people don't factor in when they're trying to think about the refinancing. So all things to keep in mind. CMHC insurance, it's obviously in the market for a reason. It helps a lot of people with getting into properties, but there is obviously an upfront cost of being able to get into these loans.
Yeah, you really have to consider essentially doing like a duplex conversion or something large and substantial to the property to build in enough equity. Just a bit of like a paint job and an upping of the rent. You're not going to be able to do much with that in terms of the increased value if you're looking to burr out. So just keep that in mind.
We did get a question here. It's I'm just going to turn the camera, guys. 1 sec. Said, how do you recommend structuring a VTB? Had a deal where $300,000, 6% interest for 3 years and interest only, 15% down. I was thinking renos and refi. Any tips to plan the next prop in the meantime? Okay, so if you're looking to plan out your next purchase after structuring this specific loan, I would make sure that your conventional financing in first position is the best financing you can get. Again, if you have a VTB on a residential property, your first position mortgage is going to be essentially private as well. So if you're carrying costs for a private loan on your first and your second, I would definitely make sure that you have enough cash flow on the property to pay that loan. It's important to also realize that private loans are usually 1-year terms. Now, you're not going to be paying any fees on the VTB or having to restructure that every single year, but your first position mortgage, you are going to have to continuously renew that mortgage. And depending on the type of lender you're working with, it could get decently expensive. So it's important to realize who is going to be taking the first position mortgage and the total cost yearly to be able to hold that mortgage, on top of obviously figuring out if the cash flow on the property is going to pay for that loan. So
yeah, you guys are essentially in that, if you're using a vendor take back, close to 100%, right? So you essentially need an entire new refinance to take out the vendor take back and the private if you don't want to continuously renew that private. So you're going to have to build in even extra equity to be able to get that ARV to a value where you can take out both on the refinance. So, being able just validating the ARV, ensuring that, at the time of ARV, you have 80% loan to value to cover your total VTB and that first position. Because if you don't, you're going to be stuck renewing that first unless you have cash to pay out the VTB, but you're still in that first position mortgage scenario. So just making sure the ARV is high enough. If not, like Josh said, you could be looking at carrying a private renewal into the next year, which isn't always it's an expensive option. You don't want to be stuck in that if you can avoid it.
Yeah, as we said before, there are institutional private lenders and mom and pop private lenders. Important to tell your mortgage broker your strategy and what the secondary financing looks like. That way, there are private lenders out there who do have a very minimal renewal fee. And that might be the better situation. You might have to maybe get a larger VTB to get into that first position product, but that renewal fee year over year might save you thousands of dollars in the long run to be able to make those numbers work. So all things to consider when looking at private financing. And last but not least, so Scotty, our business partner, he at the start of last year, somebody wants to requested to be in our live video. I don't know how to do this. Let's take a look and see. We got a question. Let's take a look. I'm just gonna try to join. In the meantime, while it tries to join. Oh, he declined. Okay. So Scott, our business partner at the start of this year, he had created a video on, he did legal and non-legal, conforming and non-conforming properties. We just dropped that a few weeks ago, and he is the expert on land development and construction financing. So the start of this year, we're going to be creating a video series based off of land financing, rezoning, construction financing, what it takes. If you want to build, what does that look like? We're going to try to release that video series Q1 of 2021. So we're really looking forward to that. Scott has a ton of knowledge that he can give and a lot of value that that maybe would open up some investment doors that you guys haven't thought of yet. Rezoning is probably the most lucrative investment vehicle that I've ever seen. A lot of people don't understand the process and how it works, but to be able to change a zoning to the highest and best use case and then having that appraised based off of what the city says you can now build on it, that has a lot of intrinsic value to people who are looking to build. Mm-hmm. And there's so many different places within the investment stack, I guess. So like all the way from land acquisition to development, rezoning, site servicing, building, takeout. There's many different types or little compartmentalized portions of the development process. And if you got really good at one of them, it's a really good way to make some quick money if you know what you're doing and you're on top of the ball. So Scott's going to be dropping that this quarter. We're really looking forward to that. And if you guys have any questions about either building or that process in general, send us a message. We'd love to be able to include it and give you guys a bunch of clarity on that as well.
Mm-hmm. And then one of the second last thing, I guess, or next last thing is just, we started to put out a lot of content at the end of the year just regarding commercial and large multifamily purchases as well too. And we just helping investors get to that next step. You've started to max out your portfolio and kind of what's next. I think we did a couple different videos. One was on just the entire application process. Right from the start, how to apply, how to assess a building and its NOI, what type of reports that you're going to need, the environmentals, the building condition reports, the appraisers, the cost and the timeline of all those as well too. It is a much lengthier process. You're looking more towards 2.5 months sometimes versus 3 to 4 weeks for a residential purchase. What to look for, what kind of lenders you're going to have access to. If it's vacant on possession or has some vacancies and it's underperforming, you might be looking at, a private mortgage to be able to get in, credit unions and how we're able to use those. The credit unions do allow for investor loans and for vendor takebacks as long as the debt service coverage ratio of the building is able to support that. So, that's a great option to be able to get in and save some capital as well too. And we've worked with some investors this year who are getting into their first, large commercial building, and it's definitely it's a different game than the residential. So just making sure you're aware of all the steps and processes first before you go into it, and working with a broker who's just experienced and understands all the different steps, in the process. So if you guys have questions on how to take your portfolio from residential and get into that large commercial and multifamily, definitely feel free to reach out and take a look at our videos, take a look at some of the steps, and then, any further questions you guys have, we'd be more than happy to answer and help you guys out with.
Yeah, that basically wraps up our first live stream of 2021. Again, guys, we appreciate every single one of you who tune in here every single week and ask questions and reach out. We're really looking forward to expanding and 10xing what we're doing right now. So I guess next week we're going to be on at the same time, 4:15. Feel free to join us then, and we'll be talking about our new video that drops. You guys are going to have to wait and see. All right, take care. Bye.
See you